Well, good afternoon. This is Bill Roller of Beacon Rock Wealth Advisors, Mike Elerath, also of Beacon Rock, and Mr. Michael Harding of Keller Williams Realtors here in beautiful sunny Vancouver. We're all back from our travels today, and this is the what is it? The week after Labor Day? No, it's been more than that. It's been 2 weeks past Labor Day. So interesting week. Dow was up 2.6%. NASDAQ Composite finished up the week at 5.94%. S&P 500 up, looks like 4.01%. SOX had a nice recovery, 9.97%. 30-year Treasury was off 4.3 basis points to an annual yield of 3.977, and the 10-year off 6 basis points to 3.650. Of course, the big news this week was the debate between former President Trump and Vice President Kamala Harris. Hope everybody enjoyed it. Always good for a couple of laughs and kind of try and discern the direction. Kind of an interesting reaction to that debate. Wednesday morning, the market said that Donald Trump lost. DJT, which is the Donald Trump, what's the exact name? That is the Trump Media and Technology Group, was down almost 16%. But for the week, it's up 11%. So kind of a big recovery in that today. He said that he's not going to be selling any shares of that. But other things that were down on Wednesday was cryptocurrencies, which has become kind of a stealth trade, also on Trump's fortunes. Solar stocks were all up, in sympathy with Kamala Harris's support of the Green New Deal, and all those seem to have pretty much kind of reversed themselves. So cryptocurrencies ended the week up, DJT ended the week up, and solar stocks ended the week down. And it looked like that the key thing was that the undecided voters, according to Reuters, tracked more for Donald Trump, 60% to 30%, with 10% undecided. Interesting. Also, Michael Harding, take a look at the real estate this week. It's also interesting that mortgage rates had a decline this week, so we can take a look at those also. Why don't I pop up your stuff here?
And everyone keep in mind that next week the Fed is expected to reduce the interest rate a quarter of a point. But at least that's the thought going in, is that it's going to be reduced by a quarter of a point. Um, Me personally, I was hoping for a 0.5%, but we can only get what we're given. So, but the market the past few weeks have been kind of topsy-turvy. If you notice, line 37, August 10th through the 16th, we were at 662,622 for a list price. Then we had a pretty steep drop down to 585,403. But then the following week, we rebounded to 642,124. There's real no explanation for such a steep movement, other than I'm sure if there's anything in the notes. I know that for the week on line 39, there were 17 houses that sold that were valued greater than $1 million. And that was quite a steep rise. Four of those were on the market 0 days, meaning the day they went on the market was the day they had an offer that was accepted, and that
Anything
was for four of them.
anything
And
common about those houses? It seems kind of quite an outlier.
yeah,
17 one
I
week.
didn't notice anything special about them. They were just your standard listings. that families were looking to sell. I don't recall if any of them were new construction. Um, so it was just an oddity that there were so many above the $1 million level. So that was just weird. So I haven't checked the past couple of days to see if the new market action from the RMLS has been released. So I'll have that for us next week. And then I was also thinking that we could take a look and see how much growth we've experienced because at the end of August last year, let's take a look at that number and go into a deeper dive as to what the numbers look like from, well, we do it from the beginning of September. My mistake, I misspoke. From the beginning of September last year to here, and let's see if we can find some averages and compare those and in terms
Uh,
of activity and price fluctuation and things of that nature. So I'll get on that for this coming week. There's very few things that brings me quite as much joy as to diving deep into the world of real estate and looking at the numbers behind the scenes. Other than spending the time with Mike and Bill, nothing else brings me as much pleasure. Back to you guys.
okay, well, it's interesting. I pulled the interest rates while we were kind of looking at that. You can see, according to this chart, Freddie Mac reported yesterday, trend on rates is definitely down. This week it was 6.2% for the 30-year fixed and 5.27% for the 15-year fixed. And that's the lowest rate since 2023. You can kind of see there. Um, where are we looking here? Kind of like, yeah, January of 2023 was the last time it was that low. So we've kind of round tripped on interest rates, um, which is could mean a number of things. I mean, it could imply that we are headed for a recession. And that's always been the question for the last few years, of course, is what's happening with the recession. The other major thing, of course, last couple of weeks, the yield curve has uninverted um, with the short end dropping, but the long end's dropped as well, which is somewhat concerning. Usually, if it goes up on the long end and say stays kind of fixed on the short end, that's known as a bull steepener. But this looks kind of a little bearish because the short end has dropped. So
Bill,
let's
may I ask a favor? And I
yeah,
apologize for interrupting. Could you bring up the spreadsheet again, please?
sure.
One thing I felt to mention that I wanted to cover real quick.
Okay, let's go back to sharing. It's amazing. Thank you, Zoom, for being so good to us. There you go.
If you've noticed the past, what is it? Since week 34, we've had more price change, meaning price reductions, than we had new to market. If
Yeah,
you go to column C,
column C. Okay, price change.
yep. If you
Yeah,
go to where it says 239, from 239 on down, we've had more price reductions than we had actual new inventory.
yeah,
And to me, this is an alarming trend because it could indicate that we're on a path to a downward uh, equity market, uh,
yeah.
month over month, year over year. And
Um,
because if you list at 500,000 and then you reduce it to 475 just to pull out some easy numbers, and if you do that enough, then you're going to have a declining market
right.
unless you get several of those, like I spoke about earlier, those $4 million homes that run the market 0 days. Unless you get several of those going on, then you'll be in a declining market. But I think that was an outlier more so than the norm. So it's just something that we got to keep an eye on. Sorry about interrupting though.
Oh, no problem. One question I had about here, particularly in Clark County, a couple of weeks ago, I read in the Wall Street Journal about Airbnb owners having some issues there, particularly some folks that had really leveraged up by a lot of real estate and put them into the Airbnb system. Has that been an issue here in Clark County that you know of?
Not that I'm aware of, but you got to consider what's the draw here to Clark County. There's really no pull factor or push factor if you compare it to other large cities. Not that I'm saying that Vancouver is a large city, but in Seattle, the attraction is, Seattle and like tech companies and things of that nature. Pardon me. But here in Vancouver and in the greater Portland area, we don't have quite the draw that someone like Seattle, San Francisco, LA, just to stay on the West Coast would have. And obviously, if you go further east in a country like New York City, Miami, things like there's no pull. And so I've always considered Airbnb to be a dangerous thing to be in for a an individual investor, unless they had rather large large amount of cash, because it's just that's all economy based. Because imagine if we do hit a recession and the travel industry takes a hit,
Yeah.
then you're on the hook for a lot of things that's sitting vacant.
Yeah, well, like everything else in finance, you can have too much of a good thing
Right,
until it's no longer a good thing.
right.
Interesting. Michael Elrath, what do you got of interest that
There's, of course, there's a lot of controversy about inflation. Next week, the Federal Reserve is going to have a meeting and make an announcement regarding the reduction in potential reduction in the Fed rates. The vast majority of financial professionals believe that the Fed will make a 1/4 point rate adjustment, which is historically consistent with softer landings as opposed to moves to try to stall a recession. And that's the other side of the coin on this. There's a number of equity investors who believe that the Fed might be too late in providing this rate relief. And if that would mean the potential for recession, unemployment, foreclosures, delinquencies on credit card debt, which is very high by historical measures. And then there's the difference in annual inflation versus the monthly inflation. The annual inflation, both headline and core, has been trending down through August. However, the monthly inflation in August ticked back up in each of those. So the monthly for core inflation approached 3.5% in August, and the headline inflation was at about 2.5% for August. So you have those, the contradictions. If you look at the annual, it's trending down, but the monthly was trending up. I've got a chart here that shows what the anticipation of housing costs might be if the Harris proposals were to go through. Let me see if I can lift this up for you. And if you can see it,
go
okay, right there.
go right there, go that way, go there you go. Not bad. Okay.
You'll see up on this end that the projection, if the
Okay.
if the gifts for purchasing housing were to come into play, would move the housing and shelter index up to about a 6.5% annualized rate of inflation. Something
So,
happened after the speeches on Wednesday morning. Stocks sold off, as you'll recall, but lumber jumped up. And why lumber? Well, lumber's a critical component of new construction. And if these housing subsidies were to be released, well, the lumber demand would be way up. So on a short-term basis, the prices of lumber jumped up. Um, so we know that in addition to the shortage of housing that there is now, that with Harris being what's called an immigration dove, then that would further complicate the outlook for real estate demand and affordability. So those were the takeoffs that I thought were of interest this week. And like we've mentioned, next week the Federal Reserve will have an extensive explanation of their decisions, and then the market will react accordingly.
yeah, don't forget, gentlemen, there's another big wild card out there, which is, of course, uh, coming at us like a freight train is the end of the federal government's fiscal year on September 30th. And as of right now, nothing seems to be happening with it. There's not a continuing resolution. Of course, there's been a push by the Republican House to tie the SAVE Act, which is the safe elections thing, concerns about election integrity with that. There was supposed to be a vote on that this week, an original vote. The SAVE Act has already been passed by the House, has not been anything done by Dick Schumer in the Senate. So they were going to tie it into a continuing resolution to keep the government funded for another 6 months. And of course, the Democrats have said that's not going to happen. So we're in a little bit of an impasse right now. So, perhaps looming out there is a government shutdown for October, which of course will scramble the markets and could even scramble the election. So be aware of that and be cautious. So even if we have a strong up day, I'm not going to be making huge commitments to the market until we see kind of what's happening with that. So, and of course, sometimes, given how profligate the spending is, sometimes the only thing worse than not having a continuing resolution is having a continuing resolution to keep the government funded.
I did a calculation yesterday. You two and me are taxpayers, and you and me will owe about $5,000 of interest per year on the current deficit balance. The 35 trillion with the interest applied divided by roughly 200 million taxpayers comes out to $5,000 each taxpayer for interest on the indebtedness.
Yes, and I believe that the total number right now is not just per taxpayer, but per American is $90,000.
Yeah, a lot of people aren't taxpayers.
Which includes your newborns. So,
yeah, right.
So interesting.
Yeah, it's going to be interesting to see how things shake out between now and November 5th, and then let the carnage begins after the 5th.
Well, I mean, there certainly is a template for that. Melly down in Argentina did some severe austerity there, and basically laid off 25% of the Argentine government. Their inflation went from 25% annually down to 4%. So, we may see some strange times depending on who gets the mandate and how strong that mandate is on the November 5th.
Yeah.
Anything you gentlemen would like to add? Well, savings. So we'll see what happens next week. When we talk, we know that the big news will be the Federal Reserve, and I can guarantee we'll either be up or we'll be down, but I doubt we'll be flat. So